Wheat, oil, natural gas, all three are gaining today, and their moves are something our next guest says you should be on the watch for. Hussein Allidina is the head of commodities research with Morgan Stanley, and he joins us now live. Hussein, oil's back at 102.24 a barrel. We're back where we were before the Japanese crisis cooled things off. Is this where we should be?
Well, you take a look at the balance today, and obviously the tragedy in Japan did take some legs out of the market. But I look at the situation in the Middle East, and I think it's gotten materially worse than where we were 2 weeks ago, a week and a half ago. So I think that there is further upside here.
And when you say the situation in the Middle East, pick your country. Are you talking about the airstrikes over Libya right now?
I think the market is very focused on Libya, but I guess I'm more concerned about the issues taking place in the GCC. You know, we've seen some pretty troubling headlines out of Bahrain, increasingly Yemen, Oman. I think the entire region is something to watch carefully.
And you travel frequently to the region. I know you're headed there again. What are the questions that you want answered?
Well, you know, the trouble really is, I don't know that even in the best of scenarios that the sort of risk that's kind of embedded in the market gets tempered. I don't know what the solution is. I wish it did. But I do know from a supply perspective, my spare capacity sits in Saudi Arabia, and bordering countries are getting increasingly concerning.
Yeah, there's that ring really about around Saudi Arabia, Qatar. You've got Yemen, you've got Bahrain in there. So when you come to look at the risk to the upside, how much of a fear premium's in here? How much more do you think we have to run? Yeah,
well, the way I think about it is sort of if everything got back to normal, tomorrow morning when I get up, maybe crude is down $5, $7 a barrel. But on the flip side, if the situation in the region does get worse, Saudi probably has 3.5 million barrels per day of spare capacity, which is not a whole lot from a global perspective, with demand continuing to increase. I could wake up tomorrow morning, crude is down $5 in the best of scenarios, and it's up, 15, 20 in a worst case scenario. So I think that risk reward here is definitely skewed to the upside.
Now, the gut reaction at first with Japan was that you're going to see an economy having to put the brakes on, you're going to see oil come down. But we know 30% of the refining capacity is taken offline. Talk to me about when demand returns and the level of supply available.
Yeah, so first, Morgan Stanley's economists have done a lot of work on kind of the impact that the earthquake and the following tsunamis could have on growth. And of course, there is an impact, but I think from an oil perspective, we've got to appreciate that these refiners that are down, you mentioned 1.3 million barrels per day, some of these are already restarting today. And I think if you look at the nuclear situation, the 9-10 megawatts of nuclear that are offline are going to be offline for far longer if they at all return to service. And I think that is going to benefit not only your LNG imports, your LNG demand, but it will benefit your fuel oil demand and your crude oil demand, as it did in 2007 following the shut-in of the KK reactor there.
And what about diesel as well? I mean, when you see a big rebuilding effort, like even with the Olympics back in 2008 in China, you saw some people say that country was hoarding supply. Are we going to see a scenario where countries return to that kind of mentality?
Well, I think it's two questions. On the first question, sort of under the rebuilding scenario in Japan, there is going to be a big rebuild that takes place there. And if we look at other examples, we look at what happened in the Gulf following Katrina, you did see an improvement in diesel demand. So I do think that the middle distillate component of the barrel will continue to get bid up as Japan reconstruction takes place. On the second part of the question, the hoarding of commodities in today's environment, I think that that will continue, particularly as food inflation and inflation generally, those fears increase. I think you will see countries try to build stocks in the event of any sort of disruption.
Hussein, we've been talking about the question of stability and the impact on oil and commodities, but talking about the root in some ways of some of that instability, and that's the kitchen table impact, the price of food. We're looking at wheat stockpiles shrinking the most in 4 years. What are you forecasting on that front?
Well, I think wheat, unlike corn and beans, is driven largely by issues on the supply side. To the extent that the coming U.S. winter wheat crop or the Russian winter wheat crop, European winter wheat crop, to the extent that those are good crops, you will see wheat prices underperform corn and bean prices, where corn and bean is driven really by demand. But, if you look at inventories for wheat, especially in exporting countries, those levels have drawn down to levels that are comparable to what we saw in 2006 and 2007. And what that means is that any sort of incremental production disruption, and we see sort of very wet weather in the northern part of the U.S. owing to a lot of the snow, any of that can really spike wheat prices higher. And I think if you do see incremental production disruptions, you will see exporting and importing countries make policy moves that are ultimately, again, constructive for wheat prices.
It sounds like a really sensitive environment that you're describing.
Well, with inventories as low as they are across much of the commodity space, you don't really have this margin for error. The corn balance in the U.S. stocks to use below 5%. We can't afford anything other than a perfect yield, and that's going to depend entirely on perfect weather in July and August.
We've got inside Japan warnings from the World Health Organization today about radiation and that impact on local food supply. What does that mean, really, in terms of pricing?
Yeah, well, Margaret, Japan is largely dependent on imports for much of their food consumption. If you look at their dependency on corn, for instance, 100% of their consumption is driven by imports. So I don't think that those issues, at least as they stand today, are that meaningful for the global balance. But I do believe you will see imports into Japan increase as sort of infrastructure and port facilities come back online. The sell-off that we saw last week on the heels of the tragedy in Japan in the grain pits was not justified by fundamentals. The ports in the south are still working, and that demand, if you can't feed it domestically, you're going to have to import that meat from the U.S., which is bullish domestically here.
Yeah, and that'll be impacting U.S. farmers here at home. Thank you so much, Hussein. It's great to talk to you.
Absolutely.